redeemable bonds, non-redeemable bonds that have coupon rate 8% at par. Jane, PSC's company stock is currently selling for 30 rupees per share, and the required rate of return for the common shareholders is estimated to be 12%. Dividends are expected to grow at a constant rate of 8% per annum indefinitely. The next dividend is expected to be rupees 120 per common share. Tax rate is 30%. Assume that flotation cost of issuing new shares is 10%. What is the existing weighted average cost of capital of the company? To maintain the current capital structure, how much of the new investment requirement must be financed from the common equity? In part B, about how much is the cost of the new fund raised, how much is the new weighted average cost of capital. Suppose you are getting this question for the exam. Do it. What are open book exam? ये open book है. ऐसा मत देने की open. एक बार उधर हाथ लगा open book दे दे. Fine. No, दे दे. नहीं करा क्या ना. एक आवाज़ दे दे वाला पार्ट के अंदर वाला बहुत पे रहना करके इनका ओपन बुक को एमए के तो वाले मारो प्रश्न देख कर लेगा वो लोग वही तीर के गिरा बेला बेला फेवरेट उत्तर दिया है आइयो मेरे लंच टाइम नहीं देखते भी वहाँ दोला तो हमारे सेशन करती है वहाँ मेरे को पहला रैंक के लगा था पहले मैं करना के हाथ तो हम बाकी नहीं पता करने वो वहाँ गाना पता है ऐसा मेरे पास ले जाना तो है पूरा तरह अपने कॉलेज 220 का यहाँ पे किस सेकंड थोड़ी लाभ है क्या मैं पढ़ी नहीं नहीं करती पढ़ी Ada camera. Ada camera. देखा था बड़ा करने का रहेगा होता है पॉजिटिव मेरा हाथ में ऐसे ध्यान नहीं होता अंदर मेरे ऐसे ध्यान नहीं गाल निकल आई there is only the question nothing to do right what is the existing debt so you are given company issue new non-redeemable bonds have a coupon 8% at par 30 million during this year company plans to issue 30 million in the new project currently selling for 30 rupees so market price currently 30 rupees share and the required rate of return on the common stock is estimated to 12%, that is given 12%. Dividend are expected to grow at a constant rate of 8%. So constant growth rate is 8%. And next dividend is expected to be 120. So that is D1 again 1.20 per common share. Tax rate is 30. Assume the flotation cost of issuing new shares is 10%. Flotation 10%. So what is the existing WACC? So weighted average cost of capital WACC. Capital structure based on the market value is as follows. Is considered to be optimal. So market value based debt capital equity given. So in the existing capital structure, what is the weight? 30 million debt, 30 million equity. So that is 50-50. That is 50-50. So you have to estimate what? Cost of debt is cost of equity is given. Right? Cost of debt to calculate the existing now without that. Additionally, they are going to raise 30 billion. That is another story there. Now, first you have to calculate the existing value. So for that, you should know weightages, weight on debt, weight on equity. That is 50-50. And also, it is given that common shareholders require rate of return also given 12%. So cost of debt is not there. How to estimate that? What is the information given for that? Cost of debt. Cost of debt, if it is suppose it's a bond, so that is like a IPM. So current interest rate, so that should reflect current debt capital providers require rate of return. That is the meaning. Cost of debt current require rate of return for the debt providers. So what information they have to estimate that? There are some things. What is that? Something. What am I doing? There is a need. If you want to make you should understand it. There is a need. Look at that. If a gardener someone now, can we take it? Just tell me why you are taking that one. That is the point. Because if that company is issuing new bonds at par, coupon rate is 8%. So it means that when the company is issuing bonds at par, coupon rate and the required rate of return for the debt capital, same thing. That is the meaning. So therefore, you can take that as the current cost of debt. Yes, that is the point. At par කියන්නේ විතරයි ඒක ගන්න පුළුවන්. දැන් මෙතන අපි හිතමු වෙන මෙහෙම දීලා තිබ්බා කියලා. You one can issue at coupon rate of 8% කියලා තිබ්බනම් no information. But it says you can issue at par. So that means coupon and YTF both are same. So therefore you can take 8%. So therefore existing WACC is equal Cost of debt you can take as the 8%, tax rate is 30, so after tax basis, rate here 50 plus cost of equity 12% into 8. So this is the existing weighted average cost of capital of the company. To maintain the current capital structure, how much of the new investment requirement must be financed from the common equity? Answer for the part B. To maintain the current capital structure, 50-50. 50 on debt, 50 on equity, 50-50. To maintain the current capital structure, how much of the new investment requirement, 30 million they are going to raise for the new investment, should be financed from the equity? What is the answer? $15 million? 50%? Yeah, not a 50-50 then again. The current capital structure is maintained currently, so 30 million they are going to raise for the new investment. So then how much should come from the equity capital? 15 million. That is the answer, 15 million. In part B above, how much the cost of new fund raise? How much the cost of new fund raise? How much is the new WACC? The cost of new fund raise for the equity cost, it is same 8%. You can take it as 8%. The cost of debt is 8%. But for the cost of equity, this is 12%. Now it says that if company is issuing new shares, there is a flotation cost. So that is you have to calculate cost of equity for the new fund raising additional the 15 million is equal E1 divided by price given 30 rupees, but you have to take after flotation cost price 10%. Flotation cost is 10%, right? Then the 10% plus growth rate 8%. Right. So what is the cost of new fund, new stock issue? Huh? 12.4. Should not have very well, right? 12.4. Right. So then you can identify MCC here. Cost of raising new fund is equal. Make a venasum 8 after tax basis 50% plus cost of new stock issue now 12.4 into marginal cost of capital. In the above A, B, how much is the cost of new fund raise? That is MCC. Right? How much the MCC? Huh? 9. It is right. It is 9%. Part B, again it asking how much is the new WACC? අපි ඉස්සර මෙතන WACC එක කියලා ආයේ ආන්සර් කීයද? 8.8. This is 8.8. How much is the new WACC? The new WACC කියන්නේ මෙයාලගේ existing capital එක තිබුණේ 60 million. Now with the extra 30, now total capital is 90 million. එතන 90 million එන්නේ කොහොමද? 50% from the debt, 50% from the equity. එතන මෙතන 50 කියන්නේ 45 million නේ. 45 මෙයාගෙන් 45. එතන equity වල 45 එක එන්නේ කොහොමද? 30 million තියෙනවා already. 30 million වලට අදාළ cost එක වෙන්නේ this is at 12%. For the 15 million extra additional raise කරන එකට cost එක වෙන්නේ 12.4. එතකොට මේ 45 අතර මේ දෙන්නගේ weight එක කීයද දෙන්නේ කියලා මට හදලා කියන්න. දැන් this is the 45 weight. මේ 45 මේ දෙන්න අතර මෙතන weight එක කීයද? 30 පහරවල යන්නේ 90 30ක් කියන්නේ කීයද? ये विधि मानो अरे मैं आलू में दिखा के ने existing cost है 33%. 33 तो मेरा सीधा 30 तो का आगे बैठेगा न्यू स्टॉक करना बाहर इधर 45 है ना इधर 45 है मैं 45 जब मैं देना तो दे देंगे 45 में मेरा वेट कितनी थी ये इधर 60 ऑलराइट हां 16.67 30.23 इधर 45 है ना right, 50, 45. So now you can calculate new weighted average cost of capital is equal. Method velocity is 8 into 1 minus 0.3 into 50 plus method velocity the method 30 million and 33.3 12% cost take 12% into 0.3333 it was say 12.4 cost take 12.4 into 16.60. So this is the new weighted average cost of capital. This is the initial WACC. This is the MCC. Here is the new weighted average cost of capital bank 8.87. This is 8.87. 8.87. For the difference of the 8.8. For the difference of this is the MCC. Right? So this is MCC again, like the discussion like question, so I think you have realized the concept. चार पदार्थ वाले but the question you are going to discuss after lunch. That's finally so you may have the lunch. If you have any clarifications on this, you can ask. Oh, so where is the മാസിക ബ്രാൻഡ് ഭൂപേതാ overall detailed बनाने understood आपकी अभी तक दिक्कत नहीं हुई है open to well just not exporting the body මේක බලන්න මේක දාලා ඊට පස්සේ මේක මේ මේක බලන්න ඕනේ I supposed to do these two questions only. Others, I think I can manage. Even this one, okay, I think. Look at this question. You are given the following financial statement of Bank of BSC for the ended 31st December. Non-current assets are there, equity and liabilities there, and non-current liabilities and the current liabilities are there. It's a balance sheet. Then ordinary shares of the company have nominal value of 10 rupees per share and the market price is 25. Company pays dividends annually and the next annual dividend will be paid in 1 year's time. Dividends are expected to provide 6% per year and into the feasible. Next dividend is expected to 2 rupees per share. Long-term borrowings of the Bank of PLC consists 16% bonds are redeemable in 6 years time at their nominal value 1000 per bond. Bond. Current market price of the bond is 1030. The preference shares of Bank of PLC have nominal value 100 rupees per share, pay and dividend 8%. Ex-dividend market value of the preference share is 60 rupees per share. Tax rate 25%, calculate the cost of debt and the weighted average, calculate weighted average after tax cost of capital for the Bank of PSC based on this balance sheet information. You feel that you can manage? Huh? We need to discuss here. So here, so you are given some balance sheet information as well as some additional information like this. So as I feel you want to estimate cost of debt, cost of equity. In the balance sheet, are there any preference shares? So long-term borrowings and the equity. Ordinary share capital, preference share capital also there. Retained earnings also. So with that, first we'll calculate after-tax cost of debt. Now this is the balance sheet. In the balance sheet, there is a long-term borrowing 25,000. Long-term borrowings of this company consist 16% bonds that are redeemable in 6 years' time at their nominal value 1000. Current market price is 1030.5. So here, based on that, you want to estimate cost of debt. What you have to do? You want to calculate the bond information is given. So redeemable in 6 years, 16% coupon, 16% coupon, and redeemable in 6 years. Nominal value is 1000. Current market price is 1030.56. So now you want to estimate cost of debt. What you calculate? What you have to calculate? You want to calculate? Yes, start it, right? Yes. Now we have estimate cost of debt. The bond is there. You can't take here coupon because it is selling at par. Sorry, not the par. Selling at premium. So you can't take coupon. So what you have done? You have calculated. You want? Yes. Near to maturity. Yes. You have to calculate YTM. So based on this information, you have to calculate YTM. Market price is there. Par value or the nominal value is there. Coupon rate is given. Time to maturity is there. Market price is 1030.5, 50. Par value like 1000. Coupon rate 16%. Annual coupon bond. Okay. Redeemable in 6 years. It is 6 years. So here we have to calculate YTM in order to estimate cost of debt. We have to calculate YTM. Now this bond is trading at premium. When a bond is trading at premium, what is the relationship between coupon rate and YTM? When a bond is trading at premium, what is the relationship between coupon rate and YTM? Is greater. Christian water करना है, देखा किसके दाल की नहीं देखा काली ने दाल इधर what is trading at premium? Which one is greater? Coupon is greater than the YTM. So that is why this bond is trading at premium. So your YTM should be greater than the coupon rate should be greater than the YTM. So on that base, you have to start with some Bayesian value, trial and error method, linear interpolation. So approximately you have to work out YTM. So let's start with coupon is 16%. So your YTM should less than that, less than that. So let's try with say 14% and see what is the number. So calculate the value of the bond at the 14. I just take at the by guessing, right? Coupon is 16, so that means 160. 1 minus 1.14 into the power 6 years divided by 14,000 divided by 1.14 into the power 6. What is the value? Take here 40% because this bond is trading at premium. Lost.
One thousand
1070. 77.78. So we are seeking this 1000. So we have to decrease this. Okay? This value should decrease. In order to decrease, that rate should, discount factor should increase. Anyway, no need to go with another one. You can take 16% as another number. Right? So now the purpose of is to identify the YTM. So therefore, I use the 16%. So if I take the 16%, the value is 1000. So therefore, in between 14, at the 14%, the value of the bond is 1077.78. So I am trying to identify rate here, that is the YTM, when the bond value is 1030.50. So if I take here 16%, the bond value is 1000 because if I take the coupon. So this is my linear interpolation table. This is the linear interpolation table. So in between this 14% and 16%, your YTM should be there. So YTM approximately is equal, it is greater than 14%, so that is plus difference between the largest value and the smallest value. The difference between 1077.78 and 1000, that is 77.878. Right? For that difference, rate has differentiated by 2%. Then difference between the largest value and the seeking value is difference. 1077 running 1030.5 how much the difference? This difference 47.28. This is 47.28. So how much the YTM approximately? Here it is. 15.21. So this is 15.21. The answer, this is not the answer, right? Question asks after tax cost of debt. So you have to adjust this for the tax. So this is before tax basis. Then after tax cost of debt is equal, tax rate is given 25. Then cost of debt after tax is equal, here is 15.2 into 1 minus tax rate. Tax rate is 25%. $11.41, right? 11.41. So this I am writing here. After tax cost of debt is 11.41. Calculate the weighted average after tax cost of capital. So to calculate the weighted average cost of capital, now you should know cost of equity and cost of preference shares also there. In their capital structure, there is preference share also. Then now you have to identify cost of equity. Some information is there to estimate the cost of equity. Company pays dividends annually and the next dividend will be paid in 1 year's time. Dividends are expected to grow by 6% per year into the possible future. The next dividend is expected to 2% per share. So we have to apply dividend growth model. With the given information, no information for the capital. So based on the dividend growth model, cost of equity you have to calculate D1 divided by price plus growth rate. The next dividend is expected to be 2 rupees. 2 rupees. And dividends are expected to grow at 6% per year. So growth rate is 6%. Current market price is 25. So then cost of equity is how much? Here then 14, 14%. Right. It is also okay. Cost of preference shares KP. For the KP, what it say? Preference shares of the Mango PLC have nominal value 1000 per share and annual dividend 8%. Dividend ex-dividend market value of the share is 80. No maturity, right? Nominal value is there. Dividend rate is 8. So this is not a redeemable. So what is the model? When the preference shares are unredeemable, value of the preference share is equal dividend divided by investors required rate of return. We apply this one in the preference share valuation. Okay? Am I correct? So the same model now we can use to estimate this KP, cost of investor required rate of return mean our cost of preference shares. So cost of preference shares is equal dividend divided by price. This is not a redeemable one, perpetual one. So therefore you can calculate like this. If it is a redeemable, like the YTM, you have to calculate. YTM approximately YTM. But this is not maturity period is not given. So say it is unredeemable. So then cost of preference shares is equal dividend 8, market price is 60. So dividend 8 means par value, nominal value 100, 8 divided by price 60. So KP .33. 30.33. Now, in order to calculate the VAT, you should know weights. Okay. Now, cost of debt, equity, and the things are okay. Now, in order to calculate this weighted average cost of capital, you should know weights. For the ordinary shares, nominal value is 10, market price 25 per share, and the preference shares nominal value is 100. For the bonds, it is 1000. So if you go to this balance sheet, now you can see. So normally balance sheet present this stated capital. So that is the way of identifying the number of ordinary shares, number of preference shares, and the number of bonds. Right? So no other way. Now there is an ordinary share capital 40,000, and also there is a retained earning 9,000. Retained earnings 9,000. So both. Now here there is no other information is provided for the retained earnings cost of capital calculation, cost of internal equity calculation. So therefore, both you can get the total of the both, that is ordinary share capital and retained earnings, because both are equity. So that 40,000 plus 9,000 divided by nominal value 10 rupees. For the ordinary shares, nominal value is 10 rupees. So therefore, you can identify number of shares here, 40,000 plus 9,000, right? 40,000 plus 9,000 divided by 49 divided by 10. So number of shares, equity, is it 4,900? So that is the way. Balance sheet base, you can calculate, you can identify number of shares, equity and the bonds like. So then market value base you can calculate weights. Then 4,900 for the bonds. Long-term borrowings is 25,000. Par value or the nominal value is 1,000. So 25,000 divided by 1,000. Is it 25? 25,000 divided by 1,000. 25. The number of bonds here 25. Then preference shares 15,000. In the section in the previous next slide it says that par value is 100. Nominal value is 100. Then 15,000 divided by 100. It is number of preference shares is equal 150. 150. Now, market value of the ordinary share is 25. Market price is 25. Bond currently trading at 1,030.5. 1,030.5. Preference shares currently trading for 60 rupees. So based on this, now calculate the weights. Market value based weights in the capital structure. Then 25,760. 25,762.5. 4,925. 122. 500. 69,000 total. $157,236.5. So then weights you can calculate. Weights on debt is equal 25 weight is 16.38%. Weight on equity 77.9%. Weight on preference shares 5.72. See you there. This summer. So now you can calculate back. So weighted average cost of capital is equal. So weighted average cost of capital is equal This is now after tax basis. After tax basis. So 11.41 into weight 1638 plus cost of equity 11 into weight 0.779 plus cost of preference shares 13.3 into 0.0572. This is the after tax basis weighted average cost of capital. The method of retained earnings and the equity shares දෙකම එකතු කරලා ගත්තා. මොකද අද information එක මුකුත් දීලා නැහැ. ඒක වෙන වෙනම ගන්න. So therefore we consider we combine it as the total equity. Okay. Right. Last section. Last one, this one. If you have any question, any problem in the calculation, please ask. Sun PLC is currently evaluating new investment project that requires additional capital of 5 million rupees. Following information is available for the Sun PLC. Debt to equity ratio 25%, cost of retained earnings 20%, cost of debt 17%, tax rate 30%. The company expects to maintain current capital structure in the future as well. If Sun PLC has 850,000 rupees retained earning, how much of the required capital of the above investment can be financed from retained earnings before new ordinary shares are issued? If Sun PLC decided to raise debt capital and external equity beyond the current level at a cost of 22% and the cost of equity 28%, compute the marginal cost of capital. Very simple thing. From that, cost of capital is over. Now, debt to equity ratio is there, cost of retained earnings is given, cost of debt is there, tax rate is given. They have 850,000 retained earnings. They need to raise additional 5 million for the investment. If the Sun PLC they have already 850,000 retained earnings with them, how much of the required capital of the above investment can be financed from retained earnings before new ordinary shares are issued? So, in other words, you have to calculate the first break point. That is what it asks you. If Sun PLC has 850,000 retained earnings, how much of the required capital of the above investment can be financed from the retained earnings before new ordinary shares is issued? So you have to work out the first break point. It was a cost of debt and the cost of equity for the new to raise the debt and external equity is given, so then calculate the MCC. Simple. Now you calculate first, yeah, existing capital structure. Weight on the debt capital and the weight on the equity capital. First you have to calculate that. It is not there. So on that you can identify first break point and then see. Calculate the capital structure, weight on the debt capital and the weight on the equity capital. Other thing is business finance rather than A plus. Hint is there. Suddenly you can cut it. Weight on the debt capital and the weight on the equity. How much the weight on debt and weight on equity. Series cost of internal equity. It was say at the cost of debt, say the existing cost of debt. May I have a wait? ඒවාගේ උත්තර දෙක ඇක්චුලි හරියට ඒක වැරදි ඒ වගේ හදන්නේ ඒ cost of equity cost of debt අදාළ වෙන්නේ debt to equity ratio is given from that you can identify based on debt capital and based on equity debt something discover here chance by chance that is great point. Then we are existing retainers. Up to what amount of capital is this sufficient? That is great point. That's great point. Now in this example, it says that debt to equity ratio may hadala dena vidiyaladi karmege me uttara debt to equity ratio given as 25. 25%. Debt to equity. Equity walata debt to equity. So මේකනේ මේ කියන්නේ 25ට 100යි කියන්නේ that's and total capital is how much? Their total capital is how much? Debt to equity 25. Debt 25, equity 100. Total capital? 125. And debt quotient here 125 වලින් 25. This is the rate of the debt capital. Equity quotient කියලා කියන්නේ 125 වලින් 100. මේක තමයි weights දෙක. ඒතර කියන්නේ මෙතනට 180යි දෙන්නේ. 180යි equity debt 120. නේ? That is the way. මේ cost එක සම්බන්ධ වෙන්නේ මේ මෙයත් අවුරුද්දක් ගාව වන්නු ආරම්භ තිබ්බා. හැබැයි මේ මේක මතක තියාගන්න this is debt to equity. Debt to equity. එතන debt to equity දුන්නොත් 125න් තමයි ගන්න ඕන. අපි හිතමු ඔයාලට දීලා තියෙනවා කියලා debt to total asset අපි මෙහෙම දීලා තියෙනවා. Debt to total asset ratio 25%. Debt to total asset මුළු asset වලින් total asset වලින් debt 125යි. එහෙනම් equity මේ රේෂියෝ එක දීලා තියෙන්නේ. දැන් විභාගෙට මේකට මේක දෙන්නත් පුළුවන්. Debt to total asset 25%. Total asset වලින් 125ක් වෙන්නේ ණය වලින්. That is the meaning. Total asset වලින් 25ක් from the debt. එහෙනම් equity කීයද? 75. එතන එහෙම ගන්න පුළුවන්. නමුත් මෙතන තියෙන debt to equity. That is the difference. This is debt to equity. This is debt to total asset. Debt to asset, total asset. දැන් මෙතන ගන්නකොට අපි ගන්න ඕන 125න් 25ක් කියලා. එතන total capital එක එන්නේ මේකේ මේ දෙන්නගේ එකතුවනේ. debt and equity එකතුවනේ. ඒතකොට ඒක 125යි. That is total 125. එතන 125 වලින් 25. 125 වලින් 9. හරිද? Right. Question number 1. If Sun PLC has 850,000 retained earnings, how much of the required capital of the above investment can be financed from the retained earnings before new ordinary shares are issued? How much of the, now they have required 5 million, right? They have required 5 million. The 5 million, they are financing how? This 5 million come 20% from the debt, 80% from the equity. Capital structure 2018. From 20% from the debt capital, 80% from the equity. There are 5 million only 20% here. 1 million. There are 5 million only 20 means that is 1 million. There are equity only may not be a month. Maybe 1 million. There are 5 million only 80% here. 4 million. 4 million from the, about 4 million should be from the equity capital. Available retained earnings is 850. About only 850 you can use for the retained earnings that is available. So for the additional 4 million only 850 give for the additional equity part, what you have to do? You have to issue new shares. Am I confusing you? Huh? Any problem? If you have any question, please ask. I can explain it again. Okay. You are working in the bank. There, आपके बैंक की वजह से क्या लग गया है? Answer? ठीक है, मोदी ने बस डेमो से करो। ठीक है, ये बैंक है। पता बस। ठीक है? अरे मेरा मतलब नहीं। Any question आपको मेरे बाहर दे? इधर debt to equity ratio एक आप भी एक करता 20% from the debt, 80% from the equity. इधर they are raising 5 million for the investment project. Either 5 million from the government, 20% from the debt capital, 80% from the equity. The 80% capital is 4 million, but internal equity available only 850. Either for the remaining, for the balance, you have to issue new shares. So this question asks if that company has 850 retained earnings, how much of the required capital of the above investment can be financed from the retained earnings before new ordinary shares issued. New ordinary shares issued. That is 850. For the balance, you have to issue new shares. May Galle that just explaining that concept actually. If the Sun PLC decided to raise debt capital and external equity beyond the current level at cost of debt 22, equity 28, compute the MCC. MCC is equal marginal cost of capital is equal MCC, right? Not the weighted average one. MCC is equal weight on the debt capital 20%, cost is 20. So here you have to take after tax cost of debt, tax rate 30. So 1 minus 0.3 plus cost of equity 28, weight is 80% into 28. So this is the marginal cost of capital, MCC, for raising this additional debt and taking this additional capital. MCC is the marginal cost of capital. MCC is how much? Hmm? 25.48, whatever, that is the answer. So that is the way of doing this. That's all about the cost of capital. If you have any question, you can ask. So now we are going to budgeting. Okay. Right. So that is long-term investment evaluation. So I think now we have entered already into this topic. Now this is the role of finance manager. You can remember our first lecture, this diagram. So this is raising capital, fundraising, issuing shares, issuing debentures, taking bank loans. So we estimate cost of capital here, right? Here you estimate the cost of capital. So then after you raise the capital from the different sources, so immediately you are investing them in the investment project. Firms mean that is the investment, portfolio of investment. So number 2, investment. So number 3, through the investment you have to generate return. This cost of capital here is the minimum required rate of return. Should be generated here in order to pay dividends and the interest. But to maximize the shareholders' wealth, to maximize the company value, to get extra, should have some extra return. So therefore, you should earn more than the minimum rate of return. So you can see how complicated, how complex this role. Suppose now you have taken bank loan here. Suppose cost of capital is 12%. You have invested this money in the investment project. Its internal rate of return is 10%. Is it a value created project? Cost of borrowing 12%. Internally generated rate of return from the project 10%. Is it a value created project? No, we cannot accept it. Right. So now here, what we are going to do under this capital budgeting, so we are going to evaluate here this investment project. Actually, when we say the capital budgeting, I uploaded your reading chapter also. That is basic. It's got many complicated areas. You are learning here nothing under the capital budgeting. Because when we say the capital budgeting, the practical complicated thing beyond that. So simply you will learn what is capital budgeting, what is that process, how to estimate cash flows for the conventional type project, and also how to apply this NPV, IRR, payback benefit. So that's a very simple fundamental thing. But when it's come to the project, like building a large apartment or like project, a lot of things are there. We have to consider. There are certain real options. After a certain period, sometimes we have to shut down the project if it is okay. So we have to consider this real option. So we have to analyze using certain models like there are sensitivity analysis, simulations, Monte Carlo scenario kind of thing. Lot of things are there that is very complicated talking in the finance. Right? But you learn very simple thing. So therefore, investment decision analysis is a separate area that you should learn, that you should you have a knowledge if you are going to further studies. So our focus here, evaluating the long-term investment project. When we say the long-term investment, how to define it? Short-term investments are there in the company, and also the long-term investments are there. How to define, how to differentiate these two? Long-term, short. Investment can be a short-term and also can be a long-term. How to differentiate these two? How to differentiate? Huh? Yes. Within the financial year, if particular investment is over, now we call it a short-term investment. Suppose that inventory, investing in the treasury bills, company also investing in treasury bills. So these are short-term. Treasury bill will be matured within the 1 year. So receivables, these are short-term investment. So long-term means, so you may invest today 1 million, trillion, like large amount of cash flow. Your return or the cash flows are generating, say, after 5 years, 10 years, so that is going for 20 years, so that such long period. So that is the capital budget. But we evaluate what is the conventional type budget. So when we say the long term, it may be more than 5 years, 10 years time, very uncertainty period we can consider. Right. So this is the connection to the our diagram. So basically, you will learn what is capital budgeting. It's a process. Main things are included. So our focus more towards on the this one, evaluating the capital budgeting using NPV, IRR, payback, profitability, MIRR, like. So that is our more focus on these areas. So you will learn related to the cash flow estimation also, you will identify different types of cash flows related to the project. So these are the things I am going to discuss under this capital budget. For the exam, we will ask questions around these areas. So when it's come to the capital budgeting, it is the decision making process, right? So we can say it is a process, not a one-shot job. It cannot be overnight decision. Sometimes to finalize a long-term investment project, it takes 6 months, 1 year sometimes. So that such process is there. Initially, you have to identify a project, you have to design the initial proposal, finance manager should have to present it into the board of directors, so higher approval. So after that, you have to do a survey, so you have to estimate the cash flows. So then you may calculate the relevant cost of capital for this project. Then you estimate the feasibility criteria by NPV, IRR. So then you may select the project. Again, you have to present this one for the board of directors. Then you get the approval. So likewise, this is a process. It takes long time. to finalize particular project. This is not a one-shot job. This is not a overnight happiness. So that therefore we call decision-making process for accepting or rejecting a long-term investment. So under the capital budgeting, we discuss long-term. So as you mentioned, when we say the long-term, it is more than financial year, more than 1 year. That is the cutoff. Capital budgeting decisions are the most complex decision facing by management. It is very complex because you can see we are dealing with the future. Expected returns coming in 10 years, 20 years, 5 years, like in the future. So very uncertain. When it's come to the future, you can decide, you can imagine the certain things can be happen. So you have to think about these probabilities. Investor expectation can be changed, sentimental things are changing. So a lot of things we have to consider. This is very complicated, very complex decision in financial management. Not like the financing. Financing is okay, but investment is very, very difficult because it exchanges current funds for the future benefits. Today we invest billion amount of money. So, but the return is coming after 10 years. So we have to wait long period. Investors have to wait long period to get the return period. So that uncertainty is there. I think you can remember the agency conflict, that agency problem. So agency problem mostly arises when these capital long-term investment projects are finalizing, because that finance manager is narrow thinking. He's look with their expectation, their survival, their job salaries and other benefits. So likewise, conflict can arise when companies taking risky long-term investment decision, because return is generating after 10, 15 years. So that benefit will get the investors, maybe the existing investors or the potential investor, immediately not the finance manager, immediately not the existing managers. So therefore they are trying to avoid as much as possible risky investment with the high potential growth. So that is because that current funds, we exchange current funds for the future benefits. So that is, you can think about the risk. Funds are invested for the long-term assets. So the returns are generating for the long period, not for the current year, not for this existing year. So the future benefits will occur from over many years. So then you can further, actually my request, it is mandatory request, this uploaded chapter under the capital budgeting, this bullets, importance of the capital budgeting is explained in under these bullets in this chapter. Right, so for the exam you will ask a question, but anyway don't write 2-3 pages in the exam, right? Right? In the bullet format I also expect the answers, but if I ask what is the importance of the capital budgeting, so by using these facts, these points, you should be able to explain, because it's affected the growth directly, company growth connected with the investment. That investment should be a value created investment. That we should have to invest in the value created investment. So if company has invested value created project, value created portfolios, then company growth is increasing. When the company growth is increasing, shareholders' wealth is maximizing, wealth is increasing. So it is affected directly to the growth of the company. Right? On that point, you should be able to explain. And also risk. No need to explain this. Risk return trade-off. Current funds for the future benefits. So it involves large amount of risk. So exactly, correctly, finance manager should be able to incorporate risk. Risk is incorporating into what? මේ ප්‍රශ්න නිකන් වලට දැනෙනවනේ උත්තරයක් දෙන්න. මේ risk factor එක incorporate වෙන්නේ මොකටද project එකේ? Cost of capital. With the cost of capital, this risk is incorporated. So higher the risk, higher will be the cost of capital. So we have to use the correct cost of capital to evaluate this particular project. Normally we are using company cost of capital to evaluate the project, assuming that this project also having same risk like the company average risk. Then අපි මේ ඔයාලගේ එකේදී අපි හැම වෙලේම company cost of capital එක තමයි පාවිච්චි කරන්නේ. On the assumption that company average risk is equal to the project risk. On that basis, we are using that company cost of capital. But practically, this is not happening. Project has unique risks. Its investments are having different degrees of risk, not like the average risk of the company. So at that time, we should be able to adjust our company cost of capital for the risk. There are certain knowledge, certain areas for that. We project එක risk එක හරියට measure කරලා cost of capital එකට ඒක අපි capture කරනවා. But ඒක certain knowledge. But here we are not going to discuss that part. We just use the company cost of capital as the project cost of capital. So risk is the other part. So it's affect to the risk and the cash flow of the company. And funding. Large amount of fund. Benefits are coming in the future. So when the company is investing large amount of the fund today, at present, so they are facing with the liquidity issue. So they might affect it with the profitability issue. In the short run, working capital struggling, they will face. Might have some problem in the company when they are investing in the large project. So that is affecting to the funding because benefits are coming after 5 years, 10 years. But currently we are investing. So that is affecting to the funding situation of the company. So therefore, when we are selecting a project, we have to be very careful whether it is a feasible, value created, good investment. Otherwise, in the long run, company will bankrupt. Will face with the financial distress, conflict situation. The other thing is the irreversibility. I told you that capital budgeting is a process. There are certain steps. So we have to follow. A process එක ගිහිල්ලා අපි decide කරාට පස්සේ once we select the particular project, reversing is not possible. You can stop, you can reverse, but large amount of sunk cost is there. Cannot recover. We cannot recover. So therefore, irreversibility is not feasible with this long-term investment project. Before taking the final decisions, we have to look back. We have to evaluate all the steps again. Because reversing involves large amount of sunk cost. So therefore, this irreversibility is a problem. Then, not much cost, but it's kind of asset, fixed asset, so that is large amount of sunk cost is there. Complexity. All these things are made very complexity in this investment decision. So you can, if you read that chapter, it is explaining these factors very nice, how this thing, these points are making this investment decision is very complex. Finance manager has to take good and as well as genuine attempt to take the good decision related to the investment. Otherwise, in future, it will be a problem to the company. So again, I am telling you that is mandatory thing. You have to read that chapter. Right. So the project we can categorize like this. Misala, you have to remind me the time as 130. Huh? 130? Because otherwise I can't manage the quiz. Right. Project we can categorize in the different way. This is the classification 1, classification 2. Under the classification 1, you can see there is expansion, diversification, refreshment, modernization. So these are investment projects. Expansion. Currently we are producing, say, certain garment items. So we are expanding our product line to another, say, related industry or unrelated industry. Can be expansion, product line, we are expanding. So these are investment projects. If you remember under the decision in the introduction, lecture 1, so we identify the investment decision. Most of the decisions come in under the investment part. And also the diversification. You know that we diversified into the different sectors, different products to minimize risk and maximize return. So again, diversification can be horizontal, vertical diversification. So these are coming under the investment decision, mergers and acquisition, investment decision. Replacement. Suppose currently we are producing our product using more labor. We call labor-intensive production process. So we can replace this labor-intensive production process with the machines, equipment, modern technologies. We can convert into the capital-intensive process. That is a replacement. Existing machine we are replacing with a sophisticated, modern now machine, new machine. Replacement. Investment decision. Modernization. Now, if you look at some government banks in 10 years back time, look at what you call this rural bank, even people's bank. How the there is no any reception, no any lobby areas, ceiling areas. Nothing, everything. But now it's modernized. AC, there is AC installations, lobby areas, reception counters, waiting counters. So likewise, certain modernization. So this modernization, even the installation of this AC machine, part of investment. Is a part of investment. That AC machine has cost. So we have to recover this cost through our process, production process. So that is even investment. And also, if you just reflect, like what you call the supermarket queues, that is I'm not observing in the food city mostly. But if you look at the queues, basically my observation, sometimes parking space is very vast, very larger than their queues outlet. So they are investing large amount for these parking lots. It's a part of investment. It consists of cost. That is an investment. Investment for the parking, investment for the research and development, all these things are coming under the either long term and short term we can categorize, but part of investment. This is some additional classification. We can classify it like this way also, mutually exclusive. What is the mutually exclusive? If we evaluate certain projects for the same purpose, that is for the same purpose, we call mutually exclusive. So it means that while one will select the particular one machine or one supplier, so automatically others are rejected. So that is we call mutually exclusive project. Accepting one will automatically reject the others. And independent means if you evaluate projects for the different purposes, that is we call independent. Say for the example, suppose Toyota company, they want to increase light vehicle production, heavy vehicle production, both by 50%. So that is the independent projects. Both. So while they increasing the production of the light vehicles, and also they are increasing that heavy vehicle production also. These are independent. They are not affecting each other. So these are independent. Dependent, or we call contingent. Actually, we are not taking example for this contingent or the umbrella type projects. Contingent or the dependent mean if a particular parent project, it depends on some other small or whatever other projects, so we call that it is a dependent project or we call contingent. Very good example for this one. Suppose a company is going to establish a factory in a very remote area. So factory establishment is the parent project. Related to this, there are certain other projects to develop the infrastructure, sanitary facilities, road development, telecommunication, education. So certain other projects are there. So success of the value of these other projects affects to the acceptance or rejection of this parent project. So this kind of things we call dependent project or contingent type project. So evaluating the contingent type project is some different. So we have to calculate combined NPV considering all the other projects also. But we do not discuss that type of project. Basically, we take the decision for the independent project and the mutually exclusive projects. So these are the some categories related to the projects. So we are not going in deep, simply what is mutual, exclusive, independent and dependent project. Right, so I told you that this is the process. Is a process. So when it says the process, it includes certain items. So I have mentioned here only important steps that we have to consider. So initially, proposal, generation, presentation, certain things are there, but I omit all these things. But initially, you have to identify cash flows related to the project. Cash flows. So three types of cash flows we have to identify. We call initial cost or the initial year cash flow. Throughout the life of the project, you have to calculate after-tax operating cash flows, and in the terminal year, we have to calculate terminal year cash flow. So based on these cash flows, we are going to evaluate the project. Remember, not the profit, but cash flows are the important. Right? You know the difference between the profit and cash flow. When we say the profit is a accounting number, it includes some non-cash items like depreciation and the things. But here we estimate operating cash flows, inflows, outflows, and the net cash flows. Normally, actually, the cash flows we estimate on the incremental basis. These are for your understanding. Incremental means that is we estimate the cash flows with and without project. If we accept the project, what is the cash flow? If we reject the project, what is the cash flow? So the difference between the with and without, we call increment. So project we evaluate based on the incremental cash flow. Then you have to assess the risk. I told you that part is very important. There are risk assessment techniques, lot of things. So by taking all these things, we have to assess the risk accurately. So after that, this risk factor we have to consider on the cost of capital of the project, or that is the project required rate of return. If the company average risk is not changing because of this project, so then this company cost of capital as it is, you can use as the project cost of capital. Otherwise, based on this risk, the project cost of capital or the project required rate of return, you have to adjust. And then finally, you evaluate the project. So our focus more on this aspect, evaluating the project using that techniques like NPV, IRR things. But anyway, to a certain degree, I am going to explain how to estimate this cash flow. Right? Okay. Any question? No need to break it. Isabel, no need to break it. May I go to the cash flow estimation? They will break it for telling me the exam. Now it is. Huh? Do you need a break? Tell me. I will. I am flexible. Do you need a break? මට මූණල් දිහා බලද්දි පේනවා ඉතින් මම මේක නිකන් මම මේ වම්දුරු බණ කියනවා කියාගෙන ගියාට වල පොඩුවට යන්නේ නැහැ කියලා මට තේරෙනවා. දැන් cash flow estimation එක පටන් ගත්තට මම දන්නවා මේ ගානට ඔයාලා incorporate කරන්නේ නැහැ කියලා. 5 minutes. All right, good. Okay, come back in 5 minutes. Shall I continue? So, estimate the cash flow. So, under the project, we have to estimate three cash flows. Basically, initial year, throughout the life of the project, after tax operating cash flow, and the terminal year cash flow. So, when we estimate the cash flows, we have to consider many things are there, but I have mentioned only this. Normally, this cash flows is impact by the price of the or the fixed asset and also the depreciation. Because you know that initial year when you purchase the particular fixed asset, so that is a cash outflow related to the project. So that is we have to consider. And then if there is any depreciation throughout the life, so we consider it as a non-cash item. So that is we have to add back when we estimate in the operating cash flows for the life of the project. So therefore, these cash flows are impact or affected by the price of the asset or the price of the investment as well as the depreciation. And other thing we have to consider when we are estimating the cash flow changes in the working capital. So that working capital means investment in the current assets. Because of this project, you might have to invest in certain current assets like say inventories, raw materials, maybe some receivables will occur, and also certain liabilities will occur. You have to take bank overdraft, some payables, certain short-term borrowings. So this working capital impact, the net working capital increase or the net working capital increase we have to consider. Net working capital means difference between the current asset and the current liability. Right? So that difference we have to consider. Normally, net working capital increase. So that net working capital is the difference between current asset and current liability. If there is an increase of the net working capital, so that is the cash outflow. So normally at the initial year, there will be some increase of the net working capital because we need certain current assets to run this particular project. So that is we have to consider as a cash outflow. And also at the terminal year, you have to release this net working capital required. So then net working capital will decrease. So that is we have to consider as a cash inflow when we are estimating this cash flows related to the project. So net working capital is the difference between current assets and current liabilities. Interest changes are not included in the project cash flow. So you know that interest is the cost of debt. So when we are estimating the project cash flow, we do not consider interest because that interest component we incorporated into cost of capital. So therefore, no need to deduct because interest is a cash outflow. Right? No need to consider that when we are estimating the project cash flow because this interest component we incorporate into the project cost of capital. So therefore, that is you are not required to consider as a cash outflow when estimating the project cash flow. Timing of the cash flow, yearly versus other period is important. You learn the timeline accordingly. When you are getting the monthly cash flow, you have to discount, you have to compound considering that. If it is a yearly cash flow, you have to consider that. Timing impact is important. So when we calculate the net present value, if you are receiving cash flow monthly, so that relevant rate discounting factor you have to consider. Right? So that is, I think you learn it. incremental cash flow, project normally we evaluate based on the incremental cash flow. So as I mentioned earlier, the relevant cash flow to be used to project analysis are the difference between cash flows the firm will have if it implements this project, if we accept this project, versus cash flows will have if it is rejected. So that difference we call incremental basis. So normally you are not going to estimate this cash flows in deeply. For your paper you will get the net incremental cash flow. Based on that you have to calculate NPV and the things. But remember, when we are evaluating the project, we have to evaluate project based on the incremental cash flows. Based on the incremental cash flow. That is the meaning. So certain points, there are more, we have to consider when we are calculating, when we are estimating this cash flows. So now let's see very simply how to determine these cash flows. First one is the initial cash flow. Then after tax operating cash flow throughout the life of the project and the terminal year after tax non-operating cash flow. If it is a new investment, if you are investing in the new project, new investment, so this is simply initial cost. So initial cost is equal, this is investment in the new project or new fixed capital related to the project. So here it includes installation charges, software charges, carrying charges, everything we have to incorporate into the fixed cost. Plus, this is change in the net working capital. Normally, in the initial year, there is an increase of the net working capital. We record certain current assets. So therefore, net working capital will increase at the initial year. So that is we have to consider as a cash outflow. It's a cash outflow. So this is for the new investment. If it is a replacement, if it is a replacement of the existing machine, existing project, so in addition to this, you have to consider it residual salvage value. Existing machine, if depreciated totally, right? If the existing machine is depreciated totally, the salvage is a profit. Salvage value is a profit. Right? On that, you have to pay tax. So that is what here we calculated. So tax is a cash outflow. If it is a replacement, right? If it is a replacement, so the salvage you can consider as a cash inflow. Salvage is a cash inflow. But anyway, on the salvage, if you are earning profit, so that is you have to pay tax. So B0 is the book value of the all fixed asset. If it is totally depreciated, so then this salvage is the profit. So on that we have to pay tax. So that is the tax adjustment related to the replacement of the project. This is related to the investment in the net working capital. So as I explained actually, working capital is the net investment in the short-term assets required for the investment. So like receivables, inventories, short-term payables generated through the project. So we have to consider it. So normally increase in the net working capital should be subtracted. Decrease in the net working capital should be added considering as a cash inflow. If it is the increase of the net working capital like increase of the current asset, so that is the cash outflow. If it is the decreasing of the net working capital, it's like a selling current asset, so that is the cash inflow. So that way you have to adjust it. Then throughout the life of the project, we have to calculate annual after-tax operating cash flow over the life of the project. So you know in the income statement, you know how to generate the operating profit. So operating profit we calculate after depreciation. Because if you recall the income statement, normally we deduct depreciation before the tax in order to identify the taxable income correctly. But here we require not the profit. This is operating cash flow, not the operating profit. So this operating profit we have to convert into the cash flow. So non-cash items we have to add back after tax profit in order to convert it into the operating cash flow. So basically you have to add the depreciation like things finally to derive to estimate the operating cash flow throughout the life of the project. So this is the formula. Actually, this is income statement based formula. Is sales minus cash operating expenses minus depreciation. E here depreciation. So this is the EBIT, earning before interest and tax. So on that we have to pay tax. So this is actually the after tax profit. From the after tax profit, we have to add back depreciation in order to calculate operating cash flow. Because project we evaluate based on the cash flow, not the profit. So therefore, profit we have to consider convert into the cash flow by adding the depreciation back. Same formula here. You can look at later. Then terminal year. In the terminal year, when the project is over, so we have to consider if there is any salvage, it is a cash inflow. And also other thing, now in the terminal year, no need any requirement for the current asset. So all these things we can relieve now. So therefore net working capital we have to recover. So that is we have to adjust at the terminal year. On the salvage value again, if there is a profit, we have to pay tax. So at the terminal year, so after tax non-operating cash flow you can calculate like this. Right. All these things I am explaining with this example. At that point, I am stopping for you. So quickly, this they can find. Quickly read this. This is not a much complicated calculation. I will explain the cash flow estimation with this example. Later, I will do another 2 examples maybe in the next week. So look at this one. Consider an investment cost that includes 200,000 rupees outlay for fixed capital items. This outlay includes 25,000 for non-depreciable land plus 175,000 for equipment. That will be depreciated straight line to zero over 5 years. Project life is 5 years. The project requires 50,000 current assets and it generates 20,000 current liabilities. So the resulting is total investment in the net working capital 30,000. Difference between the current asset and the current liabilities. Each year sales will be 250,000 rupees. From this project we are generating sales revenue 250 and the operating expenses 90,000. Income tax rate is 40%. At the end of the 5 years, company sell out the fixed capital, including land for 50,000. Additionally, the net working capital investment 30,000 is recovered because the short-term asset, short-term liabilities no longer required for this project. Project is over. So therefore, you have to estimate. You are given the required rate of return or the cost of capital relevant for this project is 10%. It's not required at this point. So you have to estimate initial year after tax operating cash flow for the 5 years and the terminal year cash flow for this example. So this is a very simple investment. This is not the reinvestment. This is a new investment. So I have no time to give you for to do yourself first, but anyway I will explain it. I have 2 questions to do with you. So now I think you got the point. Clear? Right. So now if you go to this is 5 years project. This is the 5 years project. So you have to estimate initial cash outflow and the after-tax operating cash flow and the terminal year cash flow. Now according to this project, initial year you can see cost of the project is 200,000. Right? It is 200,000. It includes 25,000 non-depreciable land. Land is not depreciating. So non-depreciable land and 175,000 equipment. So then you can consider cost of the project is 200,000. It is 200,000. Right? And 30,000, there is a current asset requirement 50,000 and the current liability is 20,000. So increase of the working capital, net working capital 30,000. So therefore you can see there is a increase of the net working capital 30,000. Then total cash outflow in the initial year at 0. Project initial year at 0, 230. Photo පස්සේ දෙන්න ෆොටෝ එක ගන්නවා මේක එක්ස්ටෙන්ඩ් කරලා නවත්තලා මගේ මේ වෙලාව ෆයිනල් ගන්න නැහැ ඔයාලගේ දැන් ටයිම් එක මම ඇඩ්ජස්ට් කරන්න ඕන PC shape right so this is 230,000 cost of the project so then throughout the life of the project look at the question please now you can see here revenue is 250 revenue is 250 cost is 90,000 ඒවා වෙනස් වෙන්නේ නැහැ මේ ගාන ලේසි they are remain constant. So therefore, for the 5 years, you can put 250 here, 2, 3, 4, like 250,000. Expenses 90,000 for the 5 years. Then depreciation. Look at this one. How much the annual depreciation? Cost of the project is 200,000. Right? Make it clear. Land is 25,000. That is not depreciable. So the equipment is 175,000 divided by 5, 35,000. So this is the annual depreciation because straight line basis for the 5 years. So therefore annual depreciation 35,000. See here for the whole 5 years it is 35,000. So then you will get operating profit before tax. Operating income before tax 125,000. Then you are paying tax 40% is given. So you can see tax is 50,000. මේ හැම අවුරුද්දකටම එකයි cost මේවා same දුන්නා 50,000. Then operating income after tax 75,000 for each year. Then after tax operating cash flow. So you can see this point is important. This is operating profit after tax. This is profit. Make a limit of 75,000 make a profit taker. So you have to attract the non-cash item. Make it 35,000 depreciation. So you attract the depreciation 35,000. So then after tax operating cash flow for the 5 years 110,000. So make it very easy. You are counting in the terminal year. Make it a terminal year. Project is no cost. එතන terminal එකේ මේක කියනවා so look at this additionally at the end of the year 5 company will sell off fixed capital asset including land for 50,000 then 175,000 equipment is totally depreciated make a totally depreciated project එකේ life එක 35,000 make a totally depreciated. At the end of the project, there is a salvage 50,000 including land. Okay? Including land. The land cost is how much? Land cost is 25,000. Land again cost is 25,000. And from the 50,000, 25,000 land cost is so on the salvage, profit is 25,000. Then I make a land cost including land 50,000 including land and I make it for 25,000 you have to pay tax. How How much the tax here? 10,000 here. 10,000? 25,000, you have to pay 40% tax. So tax is 10,000. You have to pay tax. And after tax salvage value is 40,000. After tax salvage value is 40,000. 10,000 tax. So after tax salvage is, you can see here, in the terminal year, see, after tax salvage is 40,000. How this 40,000 arrived? Like this. Either 40,000 I show you. In addition, now there is a release of the net working capital, right? Additionally, the net working capital you have to release. No need of current asset, no any current liabilities. So therefore, you have to release the net working capital. So decrease in the net working capital. Now here 30,000. Then total is 70,000. After tax cash flow for the terminal year 180,000. So project you have to evaluate based on this cash flow. First is 230,000. These are the after tax operating cash flow year 1, year 2, year 3, year 4. This is the year 5 terminal year cash flow 180,000. Now you can take the